first, we start with a panel discussion looking at impact investing, how pension schemes are making positive environmental and or social impacts with their portfolios. Now, ESG-led investing or responsible investments is about making a positive change on our planet and for our fellow citizens. So is impact investing ESG in purest form? And if so, how can you accurately measure the impact you may or may not have made? Well, to help me, I've assembled a panel. Yeah.
Good morning.
Hi, Ben. Morning.
Morning.
I just thought it's good to start here, Phil. We can just kick off and just say a few words, just introducing who we are. So, Ben, actually, would you like to kick us off?
Sure, yes. Good morning and hi, everyone. My name's Ben Constable Maxwell. I am Head of Impact Investing at M&G Investments, and my role is to support the development of our impact investing approach across the firm. I co-lead on a couple of equity impact funds, a broad-based positive impact fund and a climate solutions fund. And I'm part of our broad sustainability team, integrating ESG and focusing on engagement and sustainability and impact investing across the firm.
Thank you very much, Ben. Ian?
Hi, good morning, everybody. Hopefully you can hear and see me. I'm Ian Berger. I'm the Head of Responsible Investment at Newton Investment Management. I've been with the firm for a remarkable 23 years and always on the responsible investment side of things. It's been the investment-led approach for Newton, and I've been leading and kind of the chief architect of where we've got to in the process and the practices that we deploy today. It's been evolving over those 23 years, and it's been a lot of fun, and we've got more fun to come.
Okay, good to hear it. Ida.
Hi, thank you very much for having me and the Institute on this panel. My name is Ida Levine. I'm on the board of directors, and I'm the lead expert on policy and regulation at the Impact Investing Institute. I also sit on the board of the Investor Forum, and I have a fund management background and was with Capital Group, and before that, JP Morgan Investment Management. The Impact Investing Institute was launched in 2019 with a simple mission: to accelerate the growth and improve the effectiveness of the impact investing market in the UK and internationally. We want to see more capital contributing to the well-being of people and the planet, as set out in the United Nations SDGs. We're an independent nonprofit organization, and the Institute's core team works alongside a number of lead experts like me, providing specialist support in their fields of expertise. Our board and advisory council includes senior leaders with extensive experience in financial services industry, social investment, policymaking, and the voluntary sector.
Great. Thank you very much, Ida. And finally, Oliver.
Thanks, Mark. I'm Oliver MacArthur, Impact Research Lead at Aon. I joined Aon from the Church Commissioners in 2018. Since joining the firm, I've been heavily involved with building out our active, sustainable and impact equity offerings, as well as heavily involved with lots of responsible investment initiatives at the firm. So, yeah, really delighted to launch the Aon Global Impact Fund last year, and yeah, delighted to be part of the panel this morning.
Gotcha. Great news. Thank you, guys. It looks like we've put the right people together for a discussion like this. Starting us off, Ben, could you just explain to us how investors are measuring the impacts that they're making or that they hope they're making?
Sure, yes. Important starting question. I think it's crucial to say that impact investing sort of proves its worth by the measurement of the impacts that those investments can generate. So measurement or measurability is a really crucial concept within impact. And I think, it's a really important kind of part of the transparency that impact investors can generate and deliver to their customers and clients. So we think that you, as an investor and as an impact investor in companies or projects or assets, you need to really think about what the both positive and negative impacts that those investments have. So it's not just about focusing in on the positives. I think you have to kind of consider the overall net impact in a holistic sense, and I think that's an important part of that transparency. Investors are increasingly using different frameworks or methodologies to deliver on this measurement. Increasingly, and I would say the very significant majority of investors in the impact context are using the Sustainable Development Goals, the SDGs, to demonstrate how their investments are contributing towards the global sustainability agenda. So considering what percentage of the companies that you might be investing in, we're talking about in the listed context here, what percentage of the company's revenues, for example, might be contributing to specific SDG targets. And I think then also there's a question of whether you look at the investor, so the M&G fund, or whether it's the underlying investment that we make. And there's two different approaches. So it's a combination of thinking about what how you measure the contribution that you're making as an investor through changes you're able to affect, through engagement, through pushing for change, through pushing for tougher targets, for example, better disclosures, and or versus the measurability of the underlying the impact the underlying investment's making. And very quickly, just to say, metrics are really important. And in social and environmental areas, you use different metrics. In an environmental area, you might look at, for example, the amount of renewable energy that a company is generating, or the tons of materials that company is recycling. And on the social side, you might be thinking about sort of people who may be receiving healthcare, access to financial services, who otherwise wouldn't have received those services, that are really helping them sort of live more fuller and healthier lives. So those are the kind of approaches we take.
Thanks, Ben. A lot going on there, it seems. Ida, what trends are you seeing in the impact market?
So I think the first trend is to view impact investing expansively. Impact investing is investing made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And impact investing can be in both emerging and developed markets. It's a private investment asset class, but also it can be in the public markets. And it can be a range of returns, everything from below market to market returns based on the investor's strategic goals. And for pension funds, of course, it's important that it be more on the market side of the equation. I think the trend that I see that is most interesting is really strong engagement with public companies. And that engagement might be, for instance, aimed at achieving an impact objective like net zero emissions or decent work. And the really spectacular result that we saw from engine number one in changing the board at ExxonMobil is a good example of that. So I think pension funds can look to their engagement and the work their asset managers are doing in engaging with companies, and that's a very important avenue for impact in the public markets. Of course, in the private markets, it's much easier to invest for impact as a primary investment. Two more quickly recent developments. One is the green gilt. It's a green plus gilt. And this followed strong engagement with HMT and the DMO from the Institute, the Green Finance Institute and the Grantham Institute at LSE, and a very exciting development. This is a green bond, which also delivers or is designed to deliver well-defined social and economic benefits with associated reporting. 10 billion was raised from the sale of the gilt. It's the largest inaugural green issuance by any sovereign, with the largest order book for a sovereign green transaction, and it will be followed by another issuance later in the year. So liquidity management can be done with Green Plus. And then place-based finance, place-based impact investing is another trend, and that's bringing communities in, engaging with communities, and using investments and at different sorts of investments, so blended finance, to regenerate our communities. So those are the trends I'm seeing.
Great news. Thank you very much, Ida. Thank you. And Ian, can you give us some kind of insight into what you're seeing and how this market is evolving?
Yeah, thanks, Mark. I think really kind of crucially in picking up on the points that Ben and Ida have made around measurement, I think the biggest trend that we've seen is around data, to be fair, and really the quality, the plethora of data, the number of data points that we're getting, the breadth of those data points, and also the service providers that are giving investors an avenue and an eyesight on that data. I think it's been driven by a whole bunch of things, of course. Impact investing is the predicament around that being that you have to show you've got investment intent, you have to identify your investment objectives and your impact intent and objectives. And with that, it needs to be supported with good quality and high quality data that you can stand behind, that's rigorous. And what we've seen, I think the biggest trend that we've seen, yes, there's an increasing number of data points that we're able to identify as investors. We're also getting more primary data, which is clearly a result of kind of regulatory initiatives, increasing frameworks and standards that are being set more and more so across the industry. And there's more reliance, I think, from investors that are looking for those raw data points rather than a third party's interpretation and methodology. We know they're very different, and I think that's a really crucial development that we're seeing and we're likely to see for the next few years as the market kind of settles down a little bit more in that data provider space.
Thank you very much, Ian. Thank you. Made some good different points there. Thank you. Before we move on, if anyone in the audience has any questions for our panels at all, just send them to the Q&A box, and if we have time at the end, we might put a few to our panel. But Oliver, if we can turn to you, obviously pension funds are investing for a reason, many reasons, and one of them, of course, is they've got to pay pensioners. What kind of returns can investors hope to achieve from these sort of strategies?
Sure. My view, it's actually quite hard to kind of generalize in a nutshell. It's like, just like any investment, you can go from minus 100 to whatever you like. So I think, circling back to Ida's comments on returns, depending on the strategy, you can find investment returns that entirely aligned with the broader asset class, or perhaps earning more depending on the specific strategy. And certainly just in my specific area of expertise, where I spend probably most of my time in the public equity space, we've seen very strong results for sustainable impact equity strategies in the last year, outperforming other strategies and styles. So I think clearly there's a broad spectrum of return and risk expectations. And like I started off with saying, you can make nothing or you can make an awful lot. So I think for investors, you have to be very rigorous around the investment decision and the impact decision. So think about what exposure the impact investment is delivering in terms of risk factors, return expectations, and how they fit in the broader portfolio context too. So very hard to generalize, but clearly a wide spectrum of opportunity.
Thank you very much, Oliver. Thank you. And Ben, what about you when your clients turn to you and they say, well, this is great, we're going to be improving the planet, we're improving local communities, but how much can we expect as a return for this to help as they meet our obligations and pay our pensioners?
Yeah, I think the points that sort of Ollie and Ida made are super relevant in this context of you can make a choice, or the choice is yours as to where on that spectrum of below market rate to market rate returns that you sit. Again, talking about the listed market, the public market investments, our view is very much that if you invest in companies whose mission and whose purpose is to solve a problem, and that is aligned with with their kind of overall business strategy. And the more they grow, if you like, the greater the impact they have, then you actually see a very strong correlation and alignment between the positive impact they can generate and the financial returns they can generate. Now, it is different in different asset classes, and in the private and concessionary capital, there are options that investors can choose, which are more on the philanthropic end of the scale, where rate of return can be lower. But in a kind of market rate return context, we think that if you invest in the solutions the world needs, whether they're environmental or social, you've got very strong tailwinds behind that investment program. You still have to always be very stock specific or company specific, identify good businesses, well managed, with sustainable business models that are generating decent returns over time. But if you do that and they've got the strong tailwind of their contributing to a societal solution, we think it's a very, very strong and powerful combination for returns as well as positive impacts. The only other thing I'd say is that I think the concept of return, I think, is shifting. So I think increasingly over time, we will see a greater shift on the importance of that societal return, the social environmental return, to supplement the investment return. Because there's no point retiring in a world in which, sort of environmental damage and climate change has made our communities and regions we live in uninhabitable. So I think that's going to get greater focus by regulators and by society as time goes on. But that's a long-term thing. I think for now, you can invest for great returns by taking a positive impact approach.
Thank you, Ben. And Ian, institutional portfolios, they contain many different asset classes, of course, because diversification is key. When we talk about making an impact investing, does it only apply to equities?
I'd argue most definitely not. The equity market is fundamentally a secondary investment market, where you're not providing direct capital to the underlying company to help them in achieving their own social or environmental goals or whatever they are, or meeting the fund's objectives and intent. So really, from an equity perspective, to have the most impact, I'd venture you need to have a deliberate and rigorous stewardship approach. So that being an engagement strategy to help companies to deliver what you're expecting, and supporting that through the deliberate exercise and active exercise of your voting rights. Equity holders have a unique situation in that whole capital structure, that you're, as an equity holder, you are the legal owner of these businesses, and there you have an ability to exercise that right. Now, for other asset classes like, say, fixed income, or private equity funding, venture capital and the like, where you're providing direct capital, direct working capital to the business, I think you can there most definitely hang your hat on the fact that you are having to support and create those impacts that leads to that objective that you've got for your strategy, your fund, and maximizing that intent. And kind of going back to that data point I mentioned earlier, is that demonstrating, that's the key to it, really, is demonstrating not only your financial performance that Ben and Oliver are talking about, also demonstrating the impact that you're having through your investment strategy. That's key and critical. I mean, every asset class there is an ability, but there's nuances that what everyone needs to understand is how they can be impactful, and how you can be most impactful and most successful at your impact.
But thank you very much there. Thank you very much, Ian. Oliver, in your research, I mean, is Ian right? I mean, is this not just limited to equities?
No, I'd certainly agree with Ian's comments. I think there's clearly a wide spectrum of opportunities. You've got obviously the private market heritage of impact investing, where you have kind of clear project-based offerings, clear additionality. You can see the flow through of the money to the impact outcome. But I think more recently in the conversation, as we've highlighted earlier, public markets are very much entered the conversation, perhaps democratizing impact investing from its more kind of endowment heritage to much broader spectrum of clients. But there is a little bit of a tension there. So in the private asset class, you can obviously see the deeper impact, but perhaps it is less obvious in a public market context. So obviously clearly a wide opportunity set, but perhaps more of a philosophical comment from me. We're still seeing impact investing as distinct or new from other approaches, where I think actually in time the impact lens will be used as an approach to be applied across all asset classes and investments. So the same way investors think today holistically about risk and return, I think the market will eventually move to risk return impact in a really holistic view. So I think that's hopefully will be an area of innovation in the coming years, and certainly consultants have their role to play in helping to facilitate that decision making and help guide clients forward.
Got you. Thank you very much for that, Oliver. Thank you. Moving on, Ida, does impact investing strategies, that conflict with a fiduciary duty?
So the short answer is no. And I should say, sorry, I'm a lawyer. The Institute commissioned 5 city law firms to write a paper. It's on our website. And they came to the same conclusion. We've also put together some principles for pension fund trustees to address the issue and find solutions. An impact investment is an investment that does not conflict with fiduciary duty, is one that either has a market return or enhances the risk return profile of an investment portfolio in some other way, while at the same time generating a positive social or environmental impact. And generally, if those requirements are met, it will be consistent with trustees' fiduciary duty in a UK context. And there is a growing body of regulation that actually compels trustees to consider the implication of exposure to ESG risks in their portfolios. And in doing so, trustees can and must invest in the best interests of their pension funds members from a financial standpoint, but may also take into account impact, objectives, and factors. So my short answer is yes. I think a key issue is that, or no to, is it impossible? Yes to, you can invest. The key issue that is coming up is time horizon. And given, I think we heard this from one of the other panelists, there's short-term objectives, but there are impact factors where there's a long-term time horizon. And depending on the pension fund and the time horizon of the liabilities, there can be the opportunity to take much more of a long-term view on impact factors. So please go to our website, take a look at this legal opinion if you have the stomach to do so. And we do have these principles for trustees that have been adopted by many funds already. And maybe they will help solve this issue.
Absolutely. Thank you very much, Ida. Ian, in your experience, is there a conflict?
Well, I'll come at this from a non-legal perspective, if I may, unlike Ida, who clearly comes at it from a legal perspective. So I think fundamentally, from an investment perspective, it can be complementary, but that's caveated on the back of what is your investment approach. So let's take a thematic investment approach where you're looking at the long-term themes of the world and what's driving those prices. So I think we can dive into some of the details, but I won't go into that given the sort of time frame that we're on. Just to pick up on some examples where we're seeing kind of particularly let's take a healthy food supply chain and couple that with increasing in tax on varieties of salt, on sugar, and how that can impact on the company's valuation. I mean, currently at the moment, that impact is relatively minor, but there could be an expectation. I'm not leading investment advice here, but there could be an expectation that really impacts more and more so over the coming years as regulators become more and more concerned with with health choices of individuals and the population. So that's just kind of one small example where you can have a complementary financial performance. Those companies that are managing this area well will thrive over and above those that are not managing this area well. There's ultimately a financial impact when one takes a long-term investment horizon. And I think that's critical. If you're on a 3-month investment horizon or less, arguably the fiduciary duty element the argument becomes much weaker. But taking a longer-term strategy, it strengthens.
Thank you very much, Ian. Thank you. And Ben, the final voice on this particular point. What's your take on this?
Yeah, I mean, I think the view about fiduciary duties being misaligned with sort of ESG or sustainable investing was, I think, based on a historic view that if you invested responsibly and you avoided all the sort of, sin sectors, for example, then you were likely to sacrifice your returns as an investor. And I think that world has really shifted, and actually that situation, I think, is long gone. And we're now in a situation, I would say, where some of those long-term sustainability trends and tailwinds and the value of acting responsibly as an investor, and the regulation and societal pressures on companies to be more to act more responsibly, to have a greater clearer sustainability program. I think actually we're now in a world where, and I see this as being a structural change, where sustainable investing is more aligned with decent returns. We're talking about sort of public markets of equities and bonds here, and also the risk of significant negative returns due to scandals or controversies and those sort of things, I think also aligns with that view. So I would say the historical perspective and the reasons why there was concerns around linking ESG and fiduciary duty are long gone. And in fact, I would say that the sort of trillions and trillions of dollars invested in an unsustainable way, whether they're very high carbon or other areas of societal kind of negative impact, I would say the real challenge is it fiduciary responsible to invest in those areas or without a sustainability or positive impact lens? So I think we're really shifting, and as Ida very nicely articulated from a legal standpoint, I think the legal frameworks are shifting as well. I think there's more work to be done. The Impact Investing Institute, the PRI, and various other initiatives, and I think at the EU level, there's a lot of regulatory and legislative focus on shifting the perception on what is required as a fiduciary investor. But I'd say we're really kind of shifting away from that. And the only other comment to make would be that I think where there is still significant work to be done and probably shifting perceptions to take place is in those sort of less liquid assets that I still think you can generate a very decent return over the long term, and those also have a very positive societal impact. And I think we need to address the ability of pension funds to invest in less liquid areas of the investment chain, which are, we think over the long term can generate excellent returns as well as great societal outcomes as well.
Gotcha. So thank you very much, Ben. Oliver, interesting what you just heard there. So based on that, I mean, is impact investing the future of ESG? Is this what it's going to evolve into?
Yes, and I think it's important to contextualize that against some of the recent controversies we've been accused of in the ESG investing world, notably with the tariff fancy critique. And I think connecting that with points made earlier, my view is that controversy will prove to be an accelerant where we'll think more deeply about more sophisticated concepts of materiality, so-called double materiality, where you're actually thinking about the financial materiality alongside the real-world impacts, so no longer will they be divorced. And if that does indeed occur, then that trend, in my view, leads you towards impact investing, embedding impact concepts across client's entire investment portfolio. So that's some of the more kind of recent micro contexts. On a longer term forward looking view, obviously we've mentioned the number of sustainability challenges we have, and that's clearly a disruptive force. So the companies that will win and strengthen their competitive advantage will be companies that not only deliver for shareholders, but also deliver for wider stakeholders too, the people and the planet. So you've got the micro and the macro view there, but ultimately it's for the trustees and beneficiaries to decide. So to help the market evolve, it's important that clients make clear that what they want and make sure what's non-negotiable, what's absolutely need to have, and the market participants obviously react to deliver that. So, but yeah, it's great that we have big initiatives like Make Your Money Matter. It's actually catalysing interest and the broader effort. So I think the more that happens, the more we'll keep up the momentum to deliver more impact investing.
Thank you very much, Oliver. Thank you. And the final point of this session with Ida, have your views, please, on whether you think that impact investing is what ESG is evolving into, what it will become.
I think it is for two reasons. And these are there are concerns about green or impact washing. And it's been mentioned previously, the direction of regulation. On the greenwashing or ESG washing concern, I think the discipline, intentionality, additionality, and reporting with measurement, which will be introduced by impact investing, is likely to take sustainable investing, responsible investing to the next level. And it'll give comfort to retail and institutional investors. And it will also reap more concrete benefits for people and planet. So I do think that this is the wave of the future, and I feel that way very strongly. Regulation is taking us there. It's already moving in this direction. And the concept of double materiality has been mentioned already. The EU's Sustainable Finance Disclosure Regulation and the new proposed Corporate Sustainability Reporting Directive, which is for companies, both take a double materiality approach, requiring reporting both on the impact of the E&S on enterprise value, but also the impact of a company or a manager and its activities on people and planet. So I think this will focus attention on impacts, and they're actually using the word impact in their Q&A and in their regulations, and hopefully it'll incentivize investors and companies to introduce this discipline into the ESG investment process. I'm on the Impact Investing Task Force that has been assembled by the government for the G7 presidency. I'm on the working group on transparency, integrity, and reporting. And we're looking at the IFRS developments and other developments with the lens of impact. And I really do think this is the way of the future, and will make for a much more concrete benefit, but also for less greenwashing and a more robust market.
Thank you very much, Ida. Thank you. We are just over time, so we're going to end it there. But a very fascinating discussion, of course. I think we definitely got the right people together to talk about this. It's definitely a market, a strategy to keep an eye on. So I'd like to thank yourself, Ida, Oliver, Ben, and Ian. Thank you for your time. You've been great. Thank you.